Hello, everyone. Thank you for tuning into our video Coffee Row Egg series. To be honest, I don't drink coffee, but I still have tea here for our video, and I think Matt has something as well, too.
Got a nice cup of warm brew.
There we go. So across our conversations with clients, we found that many had tax and investment planning related questions. And our video series is going to help bring answers to those questions. Today, we're going to focus on some of the common things we hear when farms are thinking about incorporating. I'm Adam Pukalo, Portfolio Manager and Commodity Futures Advisor with PI Financial.
And I'm Matt Anhalt. I'm a Senior Manager with Virtus Group in Regina, specializing in owner-managed and agriculture services. Like Adam said, we'll be doing a 4-episode series covering the life cycle of a farm, starting with incorporation and going all the way through to winding up farming operations and their retirement process. We want to keep these videos around 15 minutes as we know that everyone is really busy. So these videos will be going over these concepts at a fairly high level. With that being said, our contact information is going to be included on the final slide, and Adam and I would be more than happy to discuss any of these items that you see in this video with you further. Well, let's jump on into things, starting with incorporation. So when incorporating, one of the main opportunities is taxation and also relations. But we're going to start with taxation, the tax deferral. So corporations have a tax rate, as you can see here, of 11% on active business income. Whereas when that income is earned personally, the lowest tax bracket is 26%, whereas the highest is 47.5%. What this means is a tax deferral. 11% means that 89% of the earnings a company has stays inside the company, allowing the company to grow, pay off debt, and just continue to grow operations rather than moving that onto taxes. Personally, the tax rates, and like I said, anywhere from 26 to 47%. So right away, you can see this significant deferral. What I'm going to do is bring up another slide here that goes over this deferral and integration a little bit further. Here we can see that integration between an individual receiving $100 of dividend income and $100 of salary income. You can see that the rates of taxes paid at the end of the day are very similar. You can see that it's just 1.13% on business income earned if that income is under $500,000. What I want to draw your attention to, though, is the bottom line. Right at the bottom there, you can see tax deferral of 28%. What this is comparing the corporate tax rate that we see compared to the personal tax rate. And what that does is that means that $28 of every 100 earned goes back into the corporation, like I said, compared to paying taxes where if it was 100% earned personally. Then in the future, we have the opportunity to pay that out as a dividend. And that's where that tax savings of that 1.13% comes in from, is if we then pay that out as a dividend. The next point I want to address is the opportunity to take advantage of crystallization or the lifetime capital gains exemption. So each Canadian has a lifetime capital gains exemption, but very few actually have the opportunity to utilize it. Farmers that own land personally are able to roll their land that they own into a corporation. And this is often referred to as crystallizing the capital gain on that land, because the land value might be, for example, 100,000, but when they purchased it, but now that land value is worth 200,000. So $100,000 capital gain can be crystallized. The benefits of this are twofold. The corporation can then present the land at the current value that is rolled into the company for, rather than the historical purchase price. This can have huge benefits when building a stronger balance sheet, because showing the land at 200,000 versus 100,000, it's easier to lend on. There's additional benefits to strengthen the balance sheet. Secondly, opportunity that's created is it creates a tax-free payable from the corporation to the individual, because the individual owned the land initially, moving into the corporation. Now the corporation owes back to the individual the value of that land. This can then be drawn on as cash is available in the corporation, since the capital gains were sheltered under this lifetime capital gains exemption. This transaction is often done with very little taxes being triggered. Next thing I want to draw attention to is the external relations. So being incorporated and being able to provide a solid set of financial statements and tax return to lenders, to banks, to insurers, builds an additional sense and builds a stronger relationship with these external relations and can pay huge dividends. Another thing is corporate succession planning. I'm not going to go over that too much here because we will specifically be touching more on that in a later episode. But the corporate succession planning makes the succession planning process, moving on to future generations of the farm operations, a lot easier. And like I said, we will discuss that more in a future video.
That's great, Matt. So now I want to go over two of the main themes that I talk to clients about from an investment planning perspective when they're thinking about incorporating. The first is that there is more than just a corporate bank account. So when you open a bank account, you should also be considering opening up an investment account as well. So again, one of the things that when you decide to incorporate that you're probably going to do is go to the bank to do that. Now, whoever looks after your investments can open up an investment account where you can start saving within your corporation. Now, one thing to note is that your corporate investment account for retirement shouldn't replace your RSP and your TFSA. They should really all be working as one. So again, that's one thing that often individuals don't know is that this now corporate investment account, you can put different types of investments within there to help save for your retirement. So it's another kind of tool in the toolbox. And I'm going to go over a little bit later what types of investments you can actually use for saving within your corporation. The second major theme that I talk to farms about when they're thinking about incorporating is dividing these funds between operating and retirement, because you should now look at starting to save consistently within this corporate investment account. And you should think of it in terms of different types of pots. So your operating account should be just for your expenses and revenues. So talking Matt's language a little bit. And on the corporate investment side, there's now some different things that you could look at doing there as well too. And one of the questions that I run into is, if you're starting a corporation, is, okay, maybe I don't have a lot of money to look at investing now. Or maybe you do have a pot of money kind of set aside to do something with. One way to look at starting to invest is actually dollar cost averaging. So dollar cost averaging is a way for you to divide up the total amount you want to look at investing across periodic purchases in an effort to really reduce that volatility and try to time the market that, again, nobody can do. So this slide here, it gives you an example. If in the second column, if you were to contribute $50 a month, and then in the first column into an S&P 500 index fund. So I won't go into what that is, but it just shows you if you were to purchase this investment each month, there's 10 periods in this example, $50 at $10 per share, you'll see how many shares you will buy, and that could fluctuate depending on the price, whether the price is higher or lower on the month. But again, your goal is to just be saving consistently. You shouldn't be really concerned about what that price is each month, because over time you will find that that dollar cost averaging scenario where you won't call the highs, you won't call the lows, you can average out to a price that over time should help your account grow in the future. So now on to Matt to talk a little bit about the startup and starting fresh for your corporation.
Perfect. Thanks so much, Adam. That was great. So I always look at it as incorporating as, like Adam said, you're starting fresh. So when you're starting fresh, you want to start good habits right off the bat. And some of those good habits that can be built on, first thing we're going to have to do is we're going to have to transfer all our corporate accounts. So when we're talking about those corporate accounts, that means transferring the names, the addresses, the contact information, anything that is connected with banks, lenders, vendors, insurance, customers. Everyone's going to have to be notified that now the operations are under this corporate name. The next thing we'll want to do is developing good administrative processes and practices. Organization, as we say here, organization is key. So utilizing tools that aren't available. There's tons of information out there, and I highly recommend get in contact with us if you have questions about that. But just doing a quick Google, there are tons of information and tools out there regarding inventory tracking, bank tracking. I know there's apps where you can take a picture of a receipt and it automatically uploads it to your bookkeeping for you, and all you have to do is allocate it. So there's lots of information out there that it eases and helps making the process. No longer are we in the days where you have to keep a manual synoptic unless that's what you're into, or an Excel synoptic unless that's what you're into. There's many ways just to expedite things, keep things organized, because the more organized you are, the quicker you can get that information to help you make those regular business decisions. If the information is late and the financial information is late, it gets more difficult to make those those tough decisions for operations. Last thing we really want to do when we start fresh is finding a trusted advisors to join your team. Your team isn't just the people that are operating the farm. Your team includes an accountant, whether that's bookkeeping, tax planning, financial reporting services. It includes a saving and investment advisor like Adam, people that can add to your team and can give you information more than just the operations. Having a good lawyer that you have in contact with, that you can ask questions to, having a banker that you are in regular communications with, an insurance provider that you can be in regular communications and can help you through the ups and downs of business operations as well. So having these people and building this team, staying organized and on top of things is a vital part of starting a corporation and being successful right off of day one, being incorporated. So I'll now go on to Adam, and he's going to look at it from starting fresh from the investment options that are available to an individual.
Thanks, Matt. So carrying on from what I was discussing prior to this was, now that you have your corporate investment account, what can you look at for types of investments? So many of my clients come from credit unions, so you're probably familiar with GICs. Well, one of the questions that I ask is, are you keeping up with inflation with those GICs? And inflation could start increasing. Again, many have thought it's been going to happen for quite some time now, but this is definitely one thing I talk to clients about. So you can purchase GICs. Again, it all depends on your risk tolerance and time horizon, but you can also purchase other exchange traded investments. So these are investments that are on the Toronto Stock Exchange, the New York Stock Exchange, the NASDAQ, the Dow. So basically, anything that you do for your RSP and your tax-free savings account, you can pretty much do within your corporate investment account too. So again, thinking about that dollar cost averaging strategy and that savings, I want to show you a way that if you were to purchase Royal Bank, the shares of Royal Bank, what your investment would look like over time. This is a chart of Royal Bank going back to 1966. And now Royal Bank has actually increased 1,200% approximately since then. And that actually doesn't include the dividends that you would have received over time. So you can see that there are some bumps along the ways. You know, in kind of the middle of the graph to the left side, that's actually in 2008. That's when Royal Bank actually did decline 60%. And even back in March of last year, Royal Bank still went down 34% as well. But you can see over time, history shows us that it looks like basically from here to here over time. And that's actually one of the reasons why dollar cost averaging strategy can help you perform over time. Because again, you can't time when the low is going to be or where the high is going to be, but it's one way for you to look at keeping to invest. Now, the last thing that I always like to go over with clients as well too is that to consider staying with lower risk and lower volatility, which is a very important point to make, because there are investments that you can look at that are like GICs. Again, they have basically no volatility and they're completely low risk, but the return isn't there. And so there are other strategies to look at that might be able to get you closer to that 3-4% with still low risk and low volatility. And that's what you really want to, I would say, target for your corporate investment account, because you already have your farm operation, you have other things there that can be more volatile. You want this savings retirement account to grow with you over time. So again, I just listed there the different types of investments that are available to you: GICs, bonds, mutual funds, exchange trade funds, stocks, even futures and options to more high risk side. So again, there's a lot of different investment options available for you out there. It just really helps to educate yourself on them. So that really wraps up our presentation here. Thank you very much for joining us. Again, I'm Adam Pukalo, Portfolio Manager and Commodity Futures Advisor with PI Financial.
Yeah, like Adam said, thanks so much for taking the time to watch this video. We hope it's created some questions and things for you to consider. Once again, Adam and I would be more than happy to help with any questions you have. Feel free to contact either of us with this information, and we look forward to seeing you all for episode 2, Make the Most of Your Corporation. Thank you so much.